Let us start with the types of bond portfolio strategies. There are two types of portfolio strategies. First, the passive portfolio strategy and the active management strategy. Now, what do you mean by passive and active management? Now, by the word itself, active means where the fund manager is taking an active role here in trying to beat its benchmark. Passive, on the other hand, always would mean that you are investing in a passive way wherein you are just trying to mimic the returns or mimic a particular benchmark. Right. Now, active investing or funds which follow active investing usually have a high cost because the fund manager is trying to generate an alpha. On the other hand, passive fund management or passive management would mean the fund manager is just trying to meet the benchmark or to meet a particular returns. The first bond trading strategy is the total return strategy. Using bonds to invest for total return or a combination of capital appreciation, that is growth, the income requires a more active trading strategy and the view on the direction of the economy and interest rates. Total return investors want to buy a bond when the price is low and sell when the price has risen, rather than holding the bond to maturity. So this strategy follows active managed strategies. Moving on to total return strategies using callable securities. Many investors use callable securities within a total return strategy with a focus on capital gains as well as income, as opposed to buy and hold strategy focused on income and preservation of principal, which is more of a passive portfolio strategy. Thus, traders using the total return strategy using callable securities use an active managed strategy. Owners of callable securities are expressing the implicit view that yields will remain relatively stable, enabling the investor to capture the yield spread over a non-callable security of similar duration. They must also have views on the likely range of rates over the investment period and the market's perception of future rate uncertainty and the horizon date. If an investor has the view that rates may be volatile in either direction over the near term but are likely to remain in a definable range over the next year, an investment is callable securities can significantly enhance returns. Premium callables may be used when the bullish investor believes that rates are unlikely to fall very far. Discount callables are better choice when the investor believes volatility will be low but prefers more protection in an environment of rising interest rates. Let's move on now to securitization. Securitization is the process of taking an illiquid asset or group of assets and through financial engineering transforming it into a tradable security. A financing company could use securitization by packaging multiple loans together and sell the security created to another investor. Increasing numbers of financial institutions employ securitization to transfer the credit risk of the assets that originate from their balance sheets to those of the other financial institutions such as banks, insurance companies, and hedge funds. In its most basic form, the process involves two steps. In step 1, a company with loans on or other income producing assets, that is, the asset originator, identifies the assets it wants to remove from the balance sheet and pools them into what is called the reference portfolio. It then sells this asset pool to the issuer, such as a special purpose vehicle, an entity set up usually by a financial institution specifically to purchase the assets and realize their off-balance sheet treatment for legal and accounting purposes. In step 2, the issuer finances the acquisition of the pooled assets by issuing tradable interest-bearing securities that are sold to the capital market investors. The investors receive fixed or floating rate payments from a trustee account funded by the cash flows generated by the reference portfolio. In most cases, the originator services the loans in the portfolio, collects payments from the original borrowers and passes them on without charging a servicing fee directly to the SPV of the trustee. Mortgage-based security is a typical example of securitization. For the investors, it provides an alternative liquid investment avenue, giving an exposure to a diversified pool of debt, which may be an attractive alternative to a corporate bond or other fixed income investments. This will ensure that the debts are taken off their balance sheet. They can raise capital and enable them to issue more loans in the market. Mortgage-backed securities are a form of debt investment where the principal and interest payments are backed by a pool of mortgages. For example, if a bank A lends 100 rupees to an individual B, then B has to pay back to A, but A lends the money from a third party to B to pay the interest to the third party. The third party in turn creates a security for the interest amount and sells it in the market. Haircut is a concept in mortgage-backed securities that we need to be familiar with. Haircut is the percentage difference between the market value of the collateral and the purchase price of the security. Collateral is intended to hedge default risk. Haircuts are usually seen as hedging the risk on the collateral. Moving to the advantages of MBS or mortgage-backed securities. First is attractive yields. They provide higher returns than traditional bonds. Next is high credit quality. MBS are one of the most secure investment vehicles from a credit standpoint. Like other debt instruments, they are evaluated and assigned a rating based on their ability to pay interest and principal as scheduled. Thirdly, diversity and investment diversification. An ABS market is highly diverse in terms of structures, yields, maturities and collateral. And lastly, we have reduced event risk. Because MBS are secured by underlying assets, they offer significant protection against event risk downgrades, particularly in contrast to corporate bonds. Asset-backed securities are bonds or notes backed by financial assets. These assets consist of receivables such as mortgage loans, credit card receivables, auto loans, manufactured housing contracts and home equity loans. Asset-backed securities are a financial security backed by a loan, lease or receivables against assets other than real estate and mortgage-backed securities. Because any asset backed by real estate or real estate is usually called as mortgage-backed securities. Financial institutions that originate loans turn their loans into marketable securities through a process known as securitization. These financial institutions sell pools of loans to a special purpose vehicle whose sole function is to buy such assets in order to securitize them. The securities which are sold to investor by the investment banks that underwrite them are credit enhanced with one or more forms of extra protection, whether internal, external or both. Finally, we come to the difference between MBS and ABS. The duration for trading MBS is more than 15 years, while that of ABS is up to 5 years. For MBS, securities include mortgage papers, house papers, land and property papers. For ABS, securities include credit card certificates, share certificates, auto or vehicle papers. Finally, we examine the clearing and settlement process for bonds. A transfer of financial instruments such as bond involves three processes. First is execution, that is when the trade is made. Next is clearing and lastly settlement. Let's begin with execution. Here the buyer and the seller enter into legally binding agreement for transfer of bonds to the buyer in exchange for money to the seller. Moving on to clearing. Clearing involves performing all the steps necessary such as updation of accounts, recording the transactions and so on. Finally, you have the settlement, which is the actual exchange of money or some other value from the securities. This is when the actual exchange of bonds for money takes place and when the ownership changes hands. Let us now take a closer look at each of these processes. The buyer will initiate the trade by placing an order, which once agreed by the seller will lead into a trade execution. Post the trade execution, custodians will be instructed via SWIFT, or that is electronic messages, to facilitate the confirmation and settlement process. Depositories are party who on behalf of the custodian will instruct the trade in the market and perform settlement activity with the help of clearing members. Once this is done, the settlement confirmation is sent back to the custodians via the depository, who will then confirm the buyer and seller of the order settlement. Settlement is an important activity. Let us examine the steps which leads to trade settlement. On the trade date, party A will instruct the broker to place the order. The broker will then find a matching party B and will execute the order in the market. On the trade plus 1 date, confirmation of the deal will be done using depositories who performs the pre-settlement and the settlement functions on trade plus 2, the settlement date. Now we have spoken about the steps involved in the settlement process. Let's look at the typical settlement depositories. Through its subsidiaries, DTCC provides clearance, settlement and information services for equities, corporate and municipal bonds, unit investment trust, government and mortgage-backed securities, money market instruments and over-the-counter derivatives. It also manages transactions between mutual funds and insurance companies and their respective investors. Clearstream is a post-trade services provider owned by Deutsche Börse. It facilitates settlement as main service as well as custody and other related services for securities across all asset classes. It is one of the 2 European international central securities depositories. Then there is Euroclear. Euroclear settles domestic and international securities transaction covering bonds, equities and derivatives. Euroclear provides security services to financial institutions located in multiple countries. We have covered strategies for bond trading, the securitization of bonds and the clearing and settlement process for bonds. With this, we reach the end of the session on bond trading. Thank you and goodbye.